All right, welcome. Today we are going to talk about 401ks, and this is going to be such a good video and it's such a good topic because a lot of people just kind of throw money in their 401k or don't and don't really know if it's a good idea or if they could be doing something better with that money or what the heck a 401k even is. So for this video, I'm going to teach you not only what options you have within your 401k or 403b, but also how to pick different contribution amounts. Like you can put 25% S&P 500 and 25% of a growth fund and 25% of real estate if they allow that. So I'm going to show you how to do that. I'm going to show you what my portfolio is all about with my 401k and make it just so that you have so many options that you get to pick, but at least you'll understand them. And so this video is not only for beginners, but it is very much a beginner style video. And so if you consider yourself as more of an advanced investor or you kind of understand 401ks, I didn't make this specifically for you, but you're probably going to learn something. But the big thing that I want you to do is I want you to be able to send this video to somebody that maybe is new to investing, or maybe it's a niece or a nephew that just got a job and they maybe need to understand like about this 401k thing and that compound interest that they're going to benefit from because of this information. And the first question that everyone always asks is, how much should I put into my 401k? And for that answer, there's an optimal amount and there's an absolutely you must amount. For the optimal amount, as long as you're putting 10 to 15% of your paycheck away into a retirement account, you're going to be totally fine. Now, if you're closer to retirement age and you haven't been saving at all, then you need to allocate a little bit more, like 25 or 30%. Now, the absolute must that you have to do is if your company offers a 401k match, you have to take that no matter what it is. If it's up to 3% of your paycheck and your paycheck is $1,000, if you put in 3%, which is just $30 of that paycheck, then your company matches that and says, we'll give you an extra $30. So that's just like you got paid $1,030 rather than just $1,000. So at the very least, take that match. But I'd also be working towards that 10 to 15% into a retirement account as soon as you can. For those of you that don't know me, my name is Nolan Govea, or Professor G. I'm a university professor and I made this channel so that I could make investing simplified. This segment is something I call office hours. And so it's going to be very lo-fi. The whole idea here is as if you were a student of mine coming to office hours, and we just have a conversation and go a little bit deeper into the lecture that I talked about. So we're gonna go through one of my 401ks. It's actually a 403b because I work for a university. We use something called Guidestone, and your 401k or your 403b is gonna be through some company that your company has decided that that's where your benefits are gonna go through. So the first thing that you're gonna do is you're gonna go to your HR person and say, I need the login or I need the information to be able to get into my 401k or 403b. I need to be able to check out those details and reallocate some of my investments. And they'll give you the website or your login info or whatever, and you're just gonna build out that profile. You've probably already built this out when you first started the job, especially if you've been there for a while. For those of you that are newer or going into a job, this is something that you'll do as well. So after I log in to my 401k, this is what it kind of looks like. It gives you a summary of where you're at. This is how much money there is after a couple of years. This year is terrible, so don't look at that. As you can see here, I have made mine 100% of something. And for this index, it's the Guidestone Equity Index GEQYX, which means absolutely nothing. So let's go ahead and look at the investment overview. You're going to be able to find that somewhere just looking at what is it that you're invested in or what can you invest in. So some type of investment overview. And for me, like I said, all of mine, my 700 shares or whatever I've accumulated over the couple of years is in this here. So we can click on that. Just a side note, the company that you work for will have something that it's already set to. And most of them will be something like a target date fund, which I'll show you in a second. And that's a very, very good one for most people who really don't care, don't want to have their hand too much into it and are cool with getting, some appreciation, 5%, 8%, something like that. And they're totally okay with that and just understand that that's probably the safest way to go and less stress-free. You don't have to worry about it. But for those of you that want to play around a little bit or look at other options, that's what this video is all about. So this one that I have is the S&P 500, but it's Guidestone's version of that. And so it's called the Equity Index GEQYX. And now the way that I found this was I went ahead and looked at all of their different funds. So I looked at, US equity, and I just went through each and every one of these and clicked on them to see what is it that this one has and what is it that this one has. And you can look through and you can kind of see they start talking about things like included in the S&P 500, or the fund will invest substantially, at least 80% of the total assets into the S&P 500 index. And so I looked through and saw like, okay, cool, this is very interesting. I can see that the fees and expenses are at 0.12. Now, side note here, you definitely want to look up the fees and expenses for your 401k and what you're invested in, because as I've talked about in a lot of other videos, the expense ratio is one of the most important things for these ETFs or mutual funds or whatever. And you can get the S&P 500 for 0.03% or 0.04%, and that is so low. And so really, I'm having to invest in the S&P 500 at 3 or 4 times as expensive as just investing in VU itself. In most of my videos, I'll say something like you should only take the company match, is because then you're getting free money from the company to be able to put that into this 401k, and because of that, it's okay that the expense ratio is so high. But if I'm putting in any extra money of my own into my 401k, that's just my pure money, then I'm just paying more money to put it into the S&P 500, whereas I could just put it in my own IRA or Roth IRA or a brokerage account and not have to pay as high of an expense ratio. So if that was confusing, I'm going to link a video down below that kind of talks a little bit more about what types of ETFs you can invest in and how to do that and when to do that. That'll be your best bet there. But anyway, here I saw that this fee wasn't that bad, 0.12 for a mutual fund. Usually, I mean, I've seen things up into 2%, 2.0%. So that is actually pretty good. Some of the things that you want to look at are things like the performance. How is it done? For me personally, I'm looking at how is the asset allocated, and then specifically what's the benchmark. So we can see that 100% of this fund is benchmarked to the S&P 500 index, and you can see that by looking at the holdings here. So this is the top 10 equity holdings. And so what I did then is I would go to, I'll go to VU here and look up, this is the Vanguard S&P 500 ETF, and just kind of look at something. The performance here, then I cross-reference that with the performance from that fund before. I'm also looking at specifically, like I was talking about before, the types of holdings within the company. And so we have Apple, Microsoft, Amazon, Tesla, Google, Berkshire Hathaway. That's their top 10 there. And so then I'll go back to the equity and see Apple, Microsoft, Amazon, Tesla, Google, Berkshire Hathaway. And so seeing that they match up. Now, it's not exactly one for one, not exactly the same, especially the percentages, but it's very close, and it's the best that you're going to get, closest thing to the S&P 500 specifically, while being able to invest in your 401k specifically. So now what you want to do is you want to look around at different funds and see, are there ones that you really care about? Like if you're watching YouTube and you hear somebody say, all right, you're going to want the S&P 500, and then, for like a little bit of your portfolio, and then another little bit of your portfolio should be a growth fund, because those are the types of companies that can just shoot off through the moon, but you don't want 100% of your portfolio there. So what I would do is look at what types of funds are there with growth in the name, and kind of just look at it. And so this one here, the growth equity index, is their name for the thing that covers the Russell 1000 growth index, right? And so same thing, we're looking at what is it specifically, and then I can type in, okay, for the Russell 1000, I'm looking at companies like Apple and Microsoft and Amazon and Google, but as you can see, the weight is so much higher. And you kind of just like, you look around and say, okay, what is this growth index? You can see that there's 500 holdings. You can also see that the return has been super, super high, almost 14% over 10 years. That's pretty crazy. So when you're looking through your 401k, 403b, there's going to be a bunch of different types of things you can do. US equity just means stocks or US stocks. Then there's non-US equity, which would be your international type of funds. There's also emerging markets, which is countries that are still emerging. Then we have fixed income, which is basically your bonds. And unless you're very, very close to retirement age, I don't recommend that you have much bonds in there, but you can do whatever you feel safest with. Then there's even things like real assets or alternatives. So we can do real estate securities and other types of things. And then next would be the target date funds. And this is what I kind of wanted to show you all, because this is what you're probably already invested in at your 401k, because it's one of the smartest ways to do it. The most hands-off, you don't have to think about anything or do anything. It's even more hands-off than the S&P 500, really. When you get closer to retirement age, so if you're 60 years old, you might be retiring either at 60 or at 65, and at that point, you don't want to be playing around. You don't want to have a huge amount of risk so that all of your stocks could go down a bunch like we're seeing right now. What this target date fund does is, as you're getting closer to retirement age, it starts adding in by itself more percentage of your fund in bonds and less percentage in the risky stuff. And so every 10 years, your bond percentage goes up. And so it kind of keeps it more stable so that you're safer as you get closer, and you never have to worry about it. You don't have to go in and change anything or click anything, and you're good. So the way that it is titled is, it's gonna say my destination or retirement date fund or something like that, and it's gonna say a year. And so the year that's closest to when you think you'll retire, probably when you're closest to 60 or 65 years old, that's the one that you're gonna be put into. So if you're going to be 65 in 2055, so 30 years from now, then what you're going to do is click on this one. So we can see here that we have 60% in just the US stocks, so think of like the S&P 500 kind of. Then we have non-US, 30%, which is just international funds. And then fixed income and cash is about 8%. So super, super low here in bonds, because you're not retiring for another 30 years, so you don't need anything crazy safe at this point. Now, if we were gonna go back, actually we're gonna be retiring in 2 or 3 years, so target date fund of 2025, now we're looking at a much different thing here, right? Now we have 40% in the stocks, 15% in international stocks, but a huge amount, 41%, altogether almost 45% of fixed income, bonds, things that are going to keep you way safer. So whereas before it was about 5 or 8% in bonds, and now it's almost 50%, that's just keeping you safe, keeping it a little bit less risky, which is so important as you get closer to that retirement age. So a lot of people will just pick to do this, because then you don't even have to watch videos like this and figure all that out. But it's a way for you to be able to invest in a smart way, because it is smart to invest and not just keep it all in cash, but also know that you're going to be safe and you won't have to worry about it. Now, the last thing that you need to know is about how to then maybe change or allocate these things, because you don't have to just pick one fund. You could pick the S&P 500 for 50%, and then maybe a growth fund for 25%, and then maybe that target date fund for another 25%. So you're gonna go back to your profile of some sort, and you're gonna try to find a place that says something like manage your investments, and you're gonna wanna go to either reallocate funds or exchange funds. Exchanging funds means that you're changing it out totally and taking one and not doing that one anymore, and now you're doing a new one. But reallocating funds would be figuring out how much percentage of each one you want to do. So as of right now, you can see that mine is 100% in that S&P 500. But if I wanted to, I could make that 50% and then maybe make the growth one 25. And then if I wanted to, I could do 25% in here. And now I have 50% of that, 25%, 25%. And so what I would recommend is that you look through all of these, you click on each one, figure out what you like about it, what you don't like about it, then you can allocate funds in whatever way. So again, for me personally, I have picked just the S&P 500 for my 401k or 403b because I like the amount of risk that's involved in that. I'm also very far away from retirement age, and so I can have that risk, and I just like the growth potential in our top 500 companies by market cap in the United States. So I'm comfortable having that there. In my other retirement accounts like Roth IRA, regular IRA, I have a lot more SCHD, a lot more dividend, and also a lot more growth as well. So I did a video recently on putting together a growth fund and a dividend fund, which could outweigh or beat the S&P 500 or VU. And so I like that strategy, those two in that retirement fund, and then the S&P 500 in another retirement fund. And for most of you, like I said, it's going to be the target date fund, but at least now you know you have options. And I would love it if you guys put more questions down below so that I can follow up on this video. What more can I add to it? What are you confused about? Absolutely love to help. So just go ahead and throw those down there, and I'll see you on the next office hours.